All right, so today is Wednesday, April 3rd. This is actually the 3:30 section. Just talking about today's in-class extra credit assignment on Nike. So again, the first thing that you would have had to do for the as-is for Nike is export the data from Bloomberg. So you needed the model. Very important. You need 6 periods, not 10. Otherwise, you're going to have a problem. So just by default, remember you go to Settings, change this from 10 to 6, and on the next tab over, make sure none of those 4 extra boxes are checked, because if you don't have 6 years, you got extra columns, it's going to break it when you try to put it into the model. Right? After you export, remember you turn them into numbers and get rid of the dashes for zeros. Okay? Then when you copy the data in to your model, which is what we did on Monday, you're overwriting this entire first tab of the previous models. This now would have the Nike data in it, right? And when you finish doing that, go to your CFI, make sure it still balances for the historical years at least, right? Because if it doesn't, that means that there's a problem with the company's data and you'd have to figure out what it is to basically make sure it does balance. I'm not giving you that next couple assignments, but it could happen later in the semester, right? Now, back to this. This is the last reported year right there, column H, 23. So remember, for NVIDIA, they're already in there. They reported 24 based on their fiscal year. So when you update the model in the assumptions, last reported year switches to 23. Okay, so you can just take it up on that last column. Make sure you use the current WACC. I did this on Monday. Today, your screenshot should say probably 9.8. Okay, models are dynamic. Same thing with the G. What I would do for G, because we're generally solving for the G, particularly if you have the 10.6% in for NVIDIA, just put 3% as a placeholder, all right? Just as a number until you can actually solve for later, all right? Shares out, make sure you put in the current shares out and the share price that matches your DES screenshot, okay? Again, you won't have this number because today's share price is different than it was on Monday, but it should be pretty close, okay? Put in the next EEO, 5 years, EBITDA and revenue, and the forward 2 years of EV to revenue and EV to EBIT. Remember that you've probably hard-coded an EBITDA margin in year 6. That's a carryover from NVIDIA. You were using that file, right? And so again, we want to have something that's representative in perpetuity. So we're going to use this range for EBIT margin based on the current trading multiples for the as-is, so somewhere between 13.5 and 14.3 is where we want this cell to be. So we change the EBITDA to get that in that range, okay? Year 6 growth rate, it's 1 year, it's not the perpetuity growth rate, but nonetheless, we still have to come up with a number for that. I left it at 6.3 on Monday, mainly because they've been growing single digits and that seemed reasonable. If they were growing 15-20% by year 6, you might want to lower that. There's a law of large number effects that kind of work their way into more maturing companies. But I don't think it's going to be a big deal for Nike. Again, in the as-is, we looked up the JP Morgan tax rate because it wasn't in the guidance, left the productivity balance sheet alone, and basically solved for RG. So you should have, using the goal seek, solve for G somewhere around 4.75%. Again, slightly different number based on today's share price. All right, and so again, there's going to be 2 dynamics at play here. One is share price is going to change the G a little bit, but number 2 is what you use for this EBITDA margin will affect your G. Okay, if you use a higher EBITDA margin, when you do the as-is, you're going to have a slightly lower G. If you have a lower EBITDA margin, you're going to have a slightly higher G. Just trying to get to the cash flows that equal the current share price, but it should still be somewhere around 4.75-ish is the number you should come in with today. Okay. This is called the as-is, right? That was the first file that you're going to be submitting. Second one you want to get to is now, yes, question? Go ahead. Not the ROIC, the EBIT margin. It's right here. Yeah, the EBIT margin in the as-is. So in the as-is, that's going to be in the ratios. What we're talking about is cell M9. Sorry, if I can just chit chat down for a minute, please. So basically, that's what you want in M9. So you basically change the EBITDA to get the M9 in that range. This is as is. Once you save the as is, we're now going to do the bull and the bear. All right. As I mentioned to you before, ideally, you want to do an EIC, all right? But practically, it's just too much work. I'm not going to make you do an EIC for every one of these valuation homeworks. But some of the pieces of the EIC are still relevant. At minimum, start looking at the BICO, okay? So if we go and look at Nike's BICO as an example, this will help you start thinking about the drivers of the industry for the bull and the bear. So for example, one of the things that they talk about with the analysts is that Nike is making a big push to become direct to consumer. All right, they're spending a lot of money on digital so that their website and their supply chain can basically go direct to consumer. And they'd like to hit eventually 60% of their sales direct to consumer. Right? So you don't buy a pair of Nike shoes in like a Foot Locker anymore, you buy it in the Nike website. That's a higher margin for Nike, okay? And so the point is, if Nike actually does achieve that, or even gets higher than 60%, well, we start thinking about that perpetuity EBITDA margin might be a little higher. You start to think about your bear. If they don't hit the 60%, that EBITDA margin might be a lower. So that's the point. This is how you can start thinking about bulls and bears. Another thing that the analysts are talking about with Nike is China. You know, China, which is a gigantic consumer market. Relations between the U.S. and China have been chilly, and the brand relations have gotten a little chilly. Right now, they're saying that it's actually warming up in China for at least Nike, and that's good for Nike, all right? Because China is a very large market with a lot of people that now have money that are spending on athleisure, right? So their international sales growth, that's going to affect your out years and your bull and your bear, how successful, for example, the international markets are. It's going to be very important to Nike. Another one that you can see as you kind of go through here is women's apparel and shoes. Just a fact. Women buy 60% of the clothes out there. Men buy 40%. Women buy 50% more clothes than women. That's just a fact. And that's the point. Nike has historically been a men's brand. And so one of the things they've been doing is they've been pushing more and more into women's apparel, women's clothes, women's shoes. And that could be very good for Nike. There's a lot more growth opportunity in that marketplace. So it's not just apparel, it's going beyond men's. All right? Now they have some women's, but they're trying to get much bigger in that. So that's one of their other pushes. How successful that push is going to be, bull and a bear. Okay? A lot of their competitive advantage in Nike is their brand. Air Jordans, that shoe alone is $1 billion a year in revenue. Okay? And they have a lot of sponsors. All right? Matter of fact, talk about female sponsors. Going to women's brands start to become much more important. But the point is, there's a lot of competition, right? Nike's not the only game in town. I was joking with the 11 a.m. section that I bought some old man running shoes. You know who I'm talking about? Who's the old man running shoes that are getting really popular? It's not New Balance. That's the old man's. Monarchs? They're called Hokas. Remember the Hoka brand? Yeah, those, the Hokas. Yeah, exactly. But the point is, Nike's now getting competition. A lot more competition, not just from the traditional brands, but some of these new emerging brands. And so the question is, what is that market share going to be longer term? And how much competition is that going to play on price in this industry? So again, if you don't think that they get as much margin because there's more competition, well, it's going to affect some of your bull bear scenarios. Okay? So I'm just giving you some things, and obviously we can read the industry report, we can read the IBIS report, just kind of glance through that. We can read some additional information. But that's what we need to at least do as a minimum. Now, obviously, when you do your group projects in a couple weeks, I'd expect a little bit more analysis than we're doing here. But at least for your next assignment, these are some of the things to think about. And even today, if we're riffing on Nike, some of the things to consider. Okay? So now we go into our bull and our bear. Doesn't matter which one you go first. But the point is, take your as is, file, save as, and I'm going to call this my bull. And this is the one I'm doing for the video. Now, when you do a bull or a bear, I'm going to add the word reasonable. Okay. So, for example, if Nike's EBITDA margin is 15.7 right now, based on Monday's data, I wouldn't put in 30 for my bull. Like, I don't think you're going to double the margins on their shoes over, up into perpetuity. I wouldn't call that a reasonable assumption. Okay, so that's the point. It's a reasonable bull in the bear. It's how high or how low could the share price be in the next 12 months? Okay, and so what would cause it to go higher? Well, let's think about the bull. Let's just say that their omni-channel strategy of having direct-to-consumer hits 60% or higher. They get there, right? It's going to help their margins, right? So instead of 16%, 15.7, I noticed in 2027, 2028, they approached 17.6%. So they get, again, maybe some regression to mean long term, but they don't regress as much. So maybe their perpetuity margin is closer to 17. Okay? So I just added $8 to the share price right there. But I'm giving you a rationale, so when we talk about write-ups, this is what I would be writing up for the reason for my assumption. Same thing with sales growth. If they're more successful in women's athleisure, if they're more successful in China and other international markets, their growth rates might be higher. So even in this out-year growth rate, maybe it's closer to 7 or 8%. And it's not going to matter that much, but what's really going to matter is when I do my G. Okay? And so again, I'm at 4.75 in my as-is. I don't want to go to 9. Remember, this is, again, a compound annual number. But maybe I go to 6, right? And they really do expand more internationally substantially. Now, I'm not going to change in my bowl the tax rate. I'm not going to change the productivity, all right? But what I'm really changing is my growth and my EBITDA, and I'm at 126 a share, okay? So that could be my bowl for Nike. I think they could get as high as 126 for these reasons. Then what I like to do is go back to the as-is, and now I'm doing my bear, buy, I'll save, bear. And usually, a lot of the things that you just talked about, it's the other side of the coin. What if Nike doesn't get to 60% with direct-to-consumer? What if it becomes a real challenge? And what if the retailers that they're replacing start to rebel against them? So they start to struggle with some of that sales growth. They start to struggle with their margins. What if the international markets aren't as successful? What if they, as they're trying to penetrate into women's apparel and athleisure, it's not as successful? What if they're having supply chain issues and costs, what we're seeing now with disruptions, more long-term, that have come out of COVID, that means that the cost of goods sold are higher. What if all of the pressure on, for example, some of the bad practices of the shoe manufacturers in Southeast Asia cause them to have higher costs, right? So again, these are things you can put in a bull and a bear that would kind of change the scenario. And so if you start to see lower growth, you start to see lower margins, you start to see a lower long-term G that's closer to 4% versus 4.75, then you're going to get a much lower share price. And that's your bull and your bear. And then the point is reasonable, okay? Nike, as a reasonable brand, it's not like their sales are going to zero, right? They're not going to shrink dramatically, likely, over the next 5 years. So we're going to be reasonable in our assumptions, but that's what we want to do, kind of research-based reasonableness. Once you do that, you then create your target share price, right? And again, the target's your opinion. And somebody asked a really good question. They said, well, do I set the price and then basically work backwards to the assumptions? It's the exact opposite. Then you put in reasonable assumptions, leads to a price, and you say, there's where I think they're going to end up based on these assumptions, explaining it, and then compare that price, your target, to the current price to do your buy, sell, hold opinion. Okay? That's the process that we should have done. Now, today I didn't make you do a write-up. I just wanted to go process to make sure everybody had kind of a working model, knew how to update it. Okay? Homework 10, due Monday, is on Costco. Right? That is the company. It's live right now. Okay? You're going to do a very similar process individually now. So you got to get your own screenshots, your own data export, your own files. No more sharing. And Costco, basically as is bull bear target, 3 screenshots for Costco, DES, WAC, EEO, and more importantly, minimum 500 word paper. And if you wonder what goes in the paper, it's what I was just talking about. As you go from model to model, here's what I changed and why, here's the basis for why I changed it. Okay? And if you're referencing real stuff, don't forget, don't plagiarize bibliographies, or at least quotations if you're direct copy and pasting. Okay? So that's what's due on Monday. Okay? 2 weeks from today is your group project presentation. I moved it from April 8th to April 17th. Right? So here's what's going to happen. On Monday, April 8th, I'm going to come in, I'm going to say, here's your industry. Each of you pick a company. So each team will have a different company, and you're going to do a valuation in a different company in that industry. So for example, let's say I say semiconductors. NVIDIA is excluded. We've already done that in class. Pick a semiconductor company. Somebody could do Intel. Somebody could do AMD. Somebody could do TMSC. Basically, you pick your company, and we'll have 6 different companies doing in different industries for different sections. Okay, so a little bit more broad than the last one. We're all doing the same companies. So on Monday, I'll give you the industry. We'll work on that. Today, before you leave, take advantage of the time to get your Costco data. All right, so that way you don't have to come back to the lab later in the week. But otherwise, assignments due on Monday. and TAs have office hours later in the week. All right. Any questions? All right. Otherwise, thanks, guys. Have a good weekend.